Welcome everyone to today's Explainer. So if you're a focused learner trying to optimize your financial strategy without getting completely bogged down in all that Wall Street jargon, well, you're in exactly the right place. Today, we're reverse engineering something genuinely fascinating. We're looking at a totally hands-off passive strategy that historically just beats active managers at their own game. No joke. It takes minimal effort, but it relies on a very specific data-driven mechanism. We're going to unpack exactly how everyday investors are capturing this massive annual rebalancing 12% boost in their returns simply by rethinking how they balance their indices. Get ready, because the math here is honestly as elegant as it is powerful.
Okay, let's dive into this. 12.35%. Now, that is not some hypothetical projection or a best-case scenario cooked up in a spreadsheet somewhere. No, that is the actual historical extended internal rate of return. And it comes from a real-world case study of a systematic investment plan running for 146 months, starting all the way back in April 2006. I mean, think about the market cycles, the sudden crashes, the crazy bull runs that happened over that specific decade. Despite all of that chaos, this strategy just steadily churned out a 12.35% return. To put that into perspective, generating that kind of consistent, compounding growth over more than 10 years, that is something most highly paid fund managers literally dream of achieving. But how is it actually done? Well, it all comes down to solving the core problem that pretty much every single index investor faces at some point.
You see, it really starts with the classic investor dilemma. When you finally decide to step away from picking individual stocks and make the move into index investing, everybody praises you for keeping things simple, right? But then you hit a wall. Which index do you actually choose? On one side, you've got the Nifty50. It's the blue chip darling. It gives you stability. It lowers your overall risk, and it lets you sleep at night. But the returns, they're steady, but maybe a little uninspiring sometimes. Then on the flip side, you have the Nifty Next50. Now this is where the growth lives, but it comes at the cost of significantly higher volatility. It is a bumpy, stressful ride for sure. So you're kind of stuck trying to choose between lower return stability and high growth stress. But what if you simply refuse to choose?
And this brilliantly illustrates the solution. It is remarkably simple, and it's called the Nifty Blend. We are not doing any complex algorithmic trading here, folks. We're literally just taking a strict 50-50 allocation split. You put exactly half of your investment into a Nifty50 index fund and the other half into a NiftyNext50 index fund. That's it. By combining equal parts, you are effectively creating the perfect compromise. You anchor your portfolio with those massive stable companies while injecting a powerful growth engine right alongside them. It's just a static, simple, halfway split that fundamentally changes your entire risk and reward profile.
But here is where this strategy gets incredibly clever from a structural standpoint. Research actually shows that this basic 50-50 allocation isn't just some random middle ground we picked out of a hat. It effectively mimics the performance of the Nifty 100 Equal Weight Index. And for the market watchers out there, you know that specific index is notoriously difficult to beat, mainly because it perfectly balances the giant companies with the up-and-comers. Active fund managers will spend endless hours and millions of dollars on research trying to outperform it, and honestly, a lot of them consistently fail. So by blending these two distinct funds in equal parts, you're basically synthetically replicating a premium benchmark entirely through the back door and without paying those premium management fees.
When you actually look at the historical performance, the results are just striking. The standard Nifty 50 and Nifty 100 indices, I mean, they're fine, but they definitely aren't optimal. Moving up a bit, you see the Nifty 100 Equal Weight Index performing very well, but outperforming all of them, sitting right there at the top, is our Nifty Blend. During that 146-month historical period we were talking about earlier, this simple 50-50 split actually surpassed the equal-weighted index. It transformed from just a simple compromise into a highly potent wealth-building tool. But here's the thing. A static split alone doesn't entirely explain that massive outperformance. There's actually a hidden gear turning in the background.
So what exactly is the secret engine driving this whole strategy? How does a seemingly static blend manage to generate that impressive annual rebalancing 12% boost over a decade? Well, the answer lies in one simple, incredibly disciplined action: annual rebalancing. Now, an ideal daily rebalancing index looks amazing on paper, but let's be real, it's a total nightmare for pragmatic investors because of taxes and transaction costs. But doing it just once a year, that is highly actionable. You see, the true power of the Nifty Blend isn't just in buying it initially, it's in what you do with it every 12 months. This annual rebalancing is the exact mechanism responsible for unlocking that 12% boost without losing your safety net.
Now, what's really interesting about this slide is seeing what actually happens to your portfolio in the real world over the course of a year. Let's say you start out perfectly at 50-50, right? Over the next 12 months, let's imagine the Nifty Next50 just goes on an absolute tear. It performs exceptionally well. Because it grew so much faster than the Nifty50, your portfolio allocation naturally drifts. You aren't at 50-50 anymore. You might now be holding a portfolio that's skewed to 60% Nifty Next50 and 40% Nifty50. Basically, your portfolio just became inherently riskier and more volatile just by sitting there doing nothing. Now, most passive investors will just freeze right here and let it ride. But a disciplined Nifty Blend investor, they do something entirely different.
They execute the rebalance. When your Nifty Next50 hits that 60% mark, your rebalancing strategy requires you to sell that excess 10% gain. You take those profits and you immediately reinvest them right back into the Nifty50 index to restore your original 50-50 ratio. This creates a forced buy low, sell high mechanism. Think about it. Human emotion usually makes us want to buy more of what's going up and panic sell what's going down, right? But this annual rebalance forces you to do the exact opposite. It's kind of like pruning a tree to keep it healthy. You systematically harvest the high-growth gains of the Nifty Next50 when they peak, and you buy the relatively cheaper Nifty50. This disciplined mechanical action is exactly what secures the annual rebalancing 12% boost over time. You are literally skimming the cream off the top year after year.
And hey, beyond the pure math of it all, there's a massive psychological advantage here too. Splitting your investments across two different funds instantly brings you so much more peace of mind compared to just going all in on a single index. Plus, it's totally customizable. If you're nearing retirement, or if the Nifty Next50 is just a little too volatile for your stomach, you don't actually have to stick to 50-50. You can easily adjust your weights to, say, 60% Nifty50 and 40% Nifty Next50, leaning more heavily into the safer index. You are in total control of the whole shebang. Best of all, it acts as a fantastic alternative to actively managed mixed funds. You avoid those higher fees, and you completely eliminate the risk of some fund manager making a bad call with your hard-earned money.
Let's move to and see how this builds into an actionable plan that you can execute today. Step 1. Choose low-cost mutual index funds. Now, our source material specifically advises against using ETFs for this strategy, mostly to avoid liquidity issues and tracking errors. Stick to mutual index funds. Step 2. Set your weights. Use that 50-50 split as your starting benchmark. Step 3. Establish your annual rebalancing plan. Just pick a date, maybe your birthday or January 1st, and commit to reviewing and adjusting those weights back to your target once every 12 months. And finally, Step 4. Be patient. This strategy is really aiming for long-term growth. It completely relies on you withstanding the inherent volatility of the Next 50, knowing that your annual rebalance is waiting right around the corner to lock in those gains.
So, we've seen the data, we've broken down the exact mechanism of the annual rebalance, and we've outlined the step-by-step framework for you to actually execute it. By embracing just a little bit of structured volatility and using that forced buy low, sell high mechanism, you can significantly boost your long-term wealth. So, I'm going to leave you with this question to ponder as we wrap up today's explainer. Are you leaving returns on the table by strictly avoiding volatility, or are you finally ready to blend? Thank you so much for learning with me today, and I highly encourage you to look at your own portfolio and see if the Nifty Blend strategy is the missing piece you've been looking for.